We welcome all to the webinar on option trading. So now let us start the webinar. Now the whole purpose of doing this webinar is to make the traders in the trading community aware of what options is, how options trading takes place, and the whole scenario of how you can trade in the options and how you can exactly make money in the options trading. So as you can see in this particular page, the topics we will be covering. We'll be starting with the basics of derivative first, moving on to the future market terminologies, then options mechanism, then option trading strategies, some derivative intelligence, and some do's and don'ts on the derivative market. Now derivative, as you understand, is that which is derived from an underlying asset. So any derivative contract is a contract which is derived from an underlying asset. So for example, if I am placing a bet on Infosys, so that particular bet would be a derivative contract and the underlying asset would be the Infosys contract or Nifty for that matter. So this is in simple terms what we call as a derivative. A forward contract was the primitive form of the derivative where the traders, the agriculturers, the manufacturers did a forward contract wherein as of today they contracted with the traders for tomorrow, as in if let's say a chips maker wants to buy some potato 3 months from now, so he'll contact with the potato agriculturers and pay some margin now, and then he'll pay the 90% amount when he gets the delivery. So the price of the potato is now locked. So if the price of the potato increases or decreases in future, he'll not be affected. Now derivative has an underlying asset. It could be an equity, it could be a forex, it could be a commodity, or any other asset for that matter. In India it started in 2001 and it is almost 1000 crore somewhat per day trading turnover currently. Now as you can see, a derivative is a betting on any of the instrument which we can see. It could be a stock market, it could be a cricket. So any betting you do is known as a derivative instrument. Now NSE trading segments. There are broadly two segments. One is the cash segment, another is the derivative segment. So in the cash segment you have intraday trading and the delivery trading. In the derivative segment you have future and the options segment trading. In the cash market it's a simple trading where you take a delivery today and it gets delivered to your Demat account T+2 days. So every settlement is done on a T+2 basis. Now in the derivative market it runs on a T+1 basis. So let's say you buy something today, the M2M or the profit and loss would be debited, credited on a T+1 basis to the client's account. Intraday trade is a trade which you do today and you settle down today. Delivery trade is a trade maybe you do it today or maybe settle down any day after today. So let's say you buy 1000 shares of Infosys or 100 shares of Infosys and you sell that particular share 2 days from now. So that is known as a delivery contract. Now how the future trading takes place. Simply there are two subsegments. One is future and another is option. Now, a future contract is a simple contract wherein you do a contract between two parties at a particular price and it has to be expired on a particular day. So let's say I buy a Nifty future, which means I'm buying a future contract of the Nifty underlying. Lot size is 50. So now if the price of future rises, the profit of the buyer would rise, and if it falls, the profit it would be in a loss, and vice versa. There is an expiry date which is almost the last Thursday of the month. That's the expiry date of the contract. If the future contract is trading at the at more than the spot contract, so let's say the Nifty future is at 5200 and the spot is at 5190, we call it as a premium. It is trading in a premium, and vice versa is known as a discount. Now there is a term which is known as rollover. So rollover is a condition where you roll your existing positions to the next position. So let's say if I have 100 lot of Nifty of January contract and I want to roll it over to the Feb contract. So I'll sell square of my January contract and buy the fresh February contract for the next month. Now, initial margin. Now this is the margin collected by the broker just before you have to put in your trade. So any trader who does not have an initial margin is not allowed to put his trade on the markets. Mark to market margin. Now it is the daily notional profit and loss made on the future trade is known as the mark to market margin. Now how the future trade payoff goes. Let's say Nifty is at 5,000 and you have bought one lot Nifty future at 5010. You think the market would rise from here. You have paid an initial margin of 25,000, which is 10% of the total contract. So as and when the Nifty rises, you will make profit. As and when the Nifty falls, you will make loss. So let's say Nifty rises to 5,300, you will make a profit of 14,500 rupees, which is 290 rupees from your cost price, multiply by the lot size. And as the Nifty falls, you will start making losses on the contract. So it is a two-phased sword. I mean, you can, it could cut you both the ways. Either if the market rises, it will be a huge profit, or the market falls, it will be a huge loss. Now understanding options, what exactly an option contract is. Simply option contract is the contract where you do a contract with the trader for a future price and at a future certified date. So call option is bought when you are bullish in the market and a put option is simply bought when you are bearish in the markets. We are not going into the proper definition because the objective is to make you earn in the market. So call is when you are bullish and put you buy when you are bearish in the markets. Options mechanism. Premium. Now premium price is the price you pay to buy or sell a particular option in the markets. Premium consists of an intrinsic value and a time value. So intrinsic value is the price, simply stating, is the price which you would receive today if the market expires after the expiry. So if let's say I bought a 5100 call and the market is at 5200, so I'm in the money for 100 rupees. My intrinsic value is 100 rupees. And time value keeps on decreasing as the time to expiry comes near. So if the time to expire is very near, the time value of an option would be very less. European and American option. So European option is an option where you can buy or sell an option. Only you can exercise it only on the expiry day. American option you can exercise any day. In India currently only the European options are being traded by the National Stock Exchange. In the money is an option where you are winning a particular bet. So for example, if the market is at 5,000 and I have an option of 4,900 call, which means I am winning the bet by 100 rupees. So my option contract is in the money. On the other side, let's say the market is at 5,000 and I have bought a 4,900 put, which means that I have still need some money, need the market to go down to make my contract in the money. At the money is where strike price and the spot price are equal, and out of the money is where you have a negative payout, which means still you have to win the contract, you have to win the bet for the trader to make money on the contract. Now options features. It gives the right but not the obligation to the buyer. It has the same contract cycle as in the future contract. Full premium has to be paid upfront, and it is a limited loss and unlimited profit for an option buyer. We'll see how it is unlimited profit. There are different strike prices available in a particular contract. It is useful in all kind of markets. It could be bullish, it could be bearish, it could be a volatile or a stable market. Now the point of difference, risk in option buying, it is limited. In option selling, it is potentially unlimited. The return in option buying, it is potentially unlimited. When you sell an option, it is an unlimited risk and limited profit contract. When you buy an option, you only have to pay initial premium amount. When you sell an option, you have to pay margin money, which is equivalent to the future contract. Advantages of option buying, it has limited risk, and option selling, it is the profit is on day one. Disadvantage is that net premium payout is on day one, and option selling, that maximum profit possible would be on the day one. Now in the next slide, as you can see, we will be discussing some option strategies, how you can trade in the options. So before going to the option strategies, first let's revise what an option contract is. Now there are two option contracts, a call and a put. You simply buy a call when you are bullish in the market. You simply buy a put when you are bearish in the markets. You have to pay a premium amount to buy a call or a put. Let's say you have paid 100 rupees premium to buy a 5100 call, which means that when the price of an underlying rises, you make a profit, and the 100 rupees will increase to 110, 120, and so on. And if the price falls of the underlying, you'll start making loss on that particular underlying contract. Now let us see the strategies. Long future, when you are highly bullish trade, you do a long future contract. You buy a future contract and you trade in the markets. Risk is potentially unlimited in a falling market, and return is potentially unlimited in a rising market. So let's say you have bought a Nifty future at 5500. When the market rises, you will make profit. When the market falls, you will make loss. It's a simple payoff for a long future contract. Similar way, a short future contract, it's a simple unlimited profit, unlimited loss kind of payoff for the short future also. Now another simple strategy, which is long call strategy. The view here is when you are high to mildly bullish, that's the view. Trade, you buy an OTM or an ATM call. Risk is limited to the premium paid, potentially unlimited profit. So let's say Nifty is at 5000 and you bought a 5100 Nifty call at 100 rupees. So here 100 rupees is the premium amount which you pay to buy a particular call option. Now as you can see, the break-even point is 5200. This is the break-even point. Because you have bought a 5100 call paying 100 rupees, so 100 rupees would be added, and this would be the break-even point. As the market rises, you can see here the profit is at 600, which is potentially unlimited profit, and the loss in the downfall would be very limited to the premium paid. So when you are bullish in the market, you simply buy a call. Now another is the covered call strategy. Now in the covered call strategy, as you can see, you are mildly bullish or ranged bullish. You buy a future and sell an OTM call option. Risk is unlimited in a bearish market because you have long a future, and return is limited. So let's say if you feel that the market is in a range of 5200 to let's say 5500, you are bullish on the market. You buy the future at 5200 and sell a 5500 call at 75 rupees. So till the price 5500, this is the maximum profit of 175 you will be making, or 5375. This is the maximum profit you will be making. But the maximum loss would be unlimited because you have done a long future. So this is only useful when you feel the markets are at the bottom and it has a very limited upside, and the bounce back is expected in the market. Now synthetic long call. Why we call it as a synthetic long call? Because this is not a long call and we have artificially traded as if we are trading in a long call option. So the market is bullish and you buy a stock or a future and you buy a put. So if the market rises, your future will give you profit. If the market falls, your put will give you a protection towards the downside. So I bought Nifty future at 6100 and bought a 6000 put at 50 rupees. Now as you can see, when the market is rising, you have got an unlimited profit. But if the market falls, you have the maximum loss, which is 150 rupees. Now the next slide, which is long put. So in the long put strategy, what you do is you simply buy a put option. When you are bearish on the market, you buy an OTM or an ATM put option. The risk is limited to the premium paid. Profit is unlimited in a falling market. So you have bought a Nifty 5800 put at 50 rupees. Payoff for long put. Now as the market falls, you make profit. As the market rises, your loss is limited to the premium amount paid. Very simple strategy. Covered put strategy, where you are ranged bearish, you sell a future and sell an OTM put. So let's say you feel that market is at 5200 and it would not fall beyond 4800. So you sell the future at 5200 and sell the put at 50 rupees, OTM put at 50 rupees. This will be the payoff. A maximum profit would be at 4800 and the maximum loss would be unlimited if the market rises. Now long straddle strategy. Now this strategy is basically used when you feel that the market would be very highly volatile on both the sides. So let's say you have a result awaited. So Nifty spot is at 6100. You have bought a 6100 call also, and you have bought a 6100 put also. If the market rises, your call would make you profit. If the market falls, your put would make you profit. But remember, the initial outgo of that particular strategy would be too high, because you are buying two particular options, a call also and a put also. So these were some basic strategies which we discussed on the option strategy side. Now let's see what open interest, PCR, rollover, etc. is. Open interest is simply the total outstanding position on that particular contract for that particular day. PCR or put call ratio is the total number of put outstanding compared to the call outstanding on that particular contract. A rollover, as we have seen, that rollover is the total contracts rolled from one particular contract to the next contract. Volatility index. Now the volatility index of a particular contract, currently in India it is only calculated for Nifty. So let's say I say India VIX is at 33% or 50, which means it has the probability of moving either side 50% for the next 1 year. Market wide position limit. This is the maximum limit through which the open interest is being allowed. You all must have seen that sometimes some contracts are being banned from trading. So this is basically if the contract reaches its market wide position limit. So it is 30 times the average daily credit of the cash segment or 20% of the non-promoter holding. Some do's and don'ts. Some do's, you should clearly understand the trade payoff before you are trading. So every trader who is trading in the options or maybe future, they should clearly understand what is the profit or loss they will be making while trading in the future contract. You should understand the margin which has to be deposited to the broker very clearly. Check all the expiry contract of the instrument before trading. The options you are trading has to be liquid traded. You should do a trend analysis before you do a trading. Some don'ts in the market. You should never over leverage when you are trading in the future contract. Should be very careful when you are selling an option. Never avoid a stop loss. Always you should put a stop loss. You should not average only because you have a money to trade. You should always see the trend or the technical analysis of the particular contract. Always cut your losses when you have done a wrong trade. So if you have done a long trade, do not shy away of cutting your losses. Always go out. If you have done a wrong trade, accept it and commit it and cut off your losses. So this was a short webinar on options trading. If you have any queries, feel free to ask your queries. We'll be more than happy to answer those.